Hello, hello. This is Austin Fitch from Horizon. I'm here with Scott Ladner as we're going to kick off our Q1 2020 quarterly review and outlook. Really appreciate everybody dialing in today and look forward to really drilling down into I think what we would all agree is one of the most historic quarters, unfortunately not in a good way. That we've really seen in quite some time. So there's a couple housekeeping items on the front end. Everybody that's logged in should have the ability to add questions in the GoToWebinar box there on your screen. We would welcome those. Actually, we would encourage those. We're going to cover a lot of content today. We're going to try and keep it as brief as possible, but that being said, there is a lot of information that we're going to dive into, just given the fact that we did see so much really happen in the first quarter. So again, encourage everybody to ask questions. We will address those as they come up and obviously as they're relevant. So look forward to hearing those. Obviously, for folks that have investment committee calls coming up, we will obviously dive into additional detail as part of those, but today is really just a snapshot of what we're seeing here at Horizon from the investment committee side. As I mentioned, got Scott Ladner here with me. He's going to give us a lot more color around the markets as a whole and some of the individual, really, I would say, things that we saw during the first quarter. But the theme today, and this is what we want to hit on at the front end, is just knowing the difference between risk and uncertainty. And Scott will talk about this here in a second, but it's this idea that risk is maybe quantifiable, whereas uncertainty is not. And we'll talk about maybe some of the risks that exist in the marketplace, both today and for that matter, as we were coming in to the events of the last couple months. But then we'll also talk about some of the uncertainty that still exists in the market, whether it's the current coronavirus pandemic that we're all dealing with, or some of the other issues that popped up from a market standpoint during the first quarter. So with that being said, we'll dive right in. And Scott, I'll toss it to you for this first slide, because I think this is a pretty good snapshot of maybe what some folks felt, hopefully not Horizon clients and folks that we're working with, but maybe even the market as a whole, what was experienced during the first quarter.
Yeah, hey Austin, and good afternoon, everybody. Yeah, certainly this is what many non-Horizon clients felt this quarter. Hopefully, if you're a Horizon client, it was not quite as bad as a Mike Tyson punch to the jaw. But I did want to use this in terms of trying to tease out a little bit of the differences between the concept of risk and the concept of uncertainty. And Austin hit it, like he defined it pretty well in that risk is fundamentally quantifiable. There are probability distributions associated with the concept of risk, but that implies something that's probably even more important, and that is that you're able to game plan for risk. Because risk, you have an idea about what history looked like, and so if you're going into the ring against Mike Tyson, you can at least game plan for him. You at least know that he hits hard. You can study his moves in the past. You can study his techniques, his tendencies, things like that. You have the ability to at least form a game plan. Whether or not you're able to keep that game plan once the bell rings is a different story, possibly. But at least you have a shot to study a game plan and to develop one. When we're talking about uncertainty, though, Donald Rumsfeld actually has a quote that's probably my favorite when describing the idea of uncertainty, and he broke it down a number of years ago by saying, listen, there are things that we know that we know. These are known knowns. There are also things that we know that we do not know, and those are the known unknowns. But the uncertainty part comes in the place where there are unknown unknowns, things that we don't even know that we don't know yet. And that's that part. If you don't know that you don't know something, how can you possibly game plan for it? And that's the place where uncertainty comes in.
No, absolutely, Scott. And I think that's a great point to bring up as, again, we're kind of setting the framework for what we're going to dive into here in a second. And I think this chart, I know folks that have been with us in the past probably recognize this chart in terms of really what the economy as a whole looked like coming into really this episode that we experienced during the first quarter. So this, for folks that maybe haven't seen it before, this is a picture of buying climate, the personal finances of individuals and consumers in the U.S., but then also the consumer's opinion on just the state of the economy. And what you can tell, irregardless of which line you're looking at or which data set is coming into 2020 for that matter, we were nearing historical or even multi-decade highs in regards to all three of these data sets. A really strong economy as a whole, which as many of you that were on last quarter's call probably remember, this actually set up well for a 2020 market, both globally, but also in the U.S. And I think understanding kind of where we were is really important, because then, Scott, to your point, then you get something like the coronavirus or COVID-19, and then that gives you a data point like this. And Scott, maybe take a second let's talk about how this is maybe a perfect snapshot of uncertainty.
Yeah, I mean, so this is a data series that we have that goes back 50 plus years. This is initial jobless claims. It's a weekly number. We just got another number that was even worse, and it's expected to be worse. So it's not a surprise. But these data points that we're getting right now from an economic standpoint are without historical precedent. There is no game plan for what is happening right now. That little blip that you see in 2008 and 2009 at the in that period, just look at how irrelevant that point is in the context of what we're experiencing right now. So this suggests this idea that we have a very the ability to model and ability to forecast out of something like this is really very challenged, because we don't have anything historically to go back and look upon to inform our opinions. But this is a picture of uncertainty. This is a picture of there is nothing that I can look at in the past that will give me an idea for what to expect going forward. And the way you manage money, and the way you manage risk, and the way you manage portfolios and your clients' behavior in a time like this is just falls under a different set of categories than if you're dealing with just a kind of a run-of-the-mill risky market.
No, for sure. And Scott, we'll look at something here in a few slides where if you're using some sort of modeling framework, data points like this can obviously create kind of nonsensical output. And I think it's really interesting to look at this chart, but then also to look at the effects of that, which we'll do here in a second. But with that being said, let's maybe back up to coming into this crisis. As I mentioned earlier, obviously there were risks. And again, risks can be quantified. One of those risks from a market perspective was the risk of kind of how the U.S. election played out, right? And this is a chart that looks at the betting odds of a presidential election, where whether or not it's going to be the Republican or the Democrat, the red shaded area indicates the Democrat being the favored nominee. The green shaded area would indicate President Trump, or the Republican being the favorite. I think it's pretty crazy to see that the 6 months leading up to kind of this pandemic, you actually had a swing of over 30% in regards to the favorites. And that in and of itself creates a little bit of volatility in the market, because you do have kind of this risk component bouncing back and forth. You see where we end today and where we ended at the end of the quarter. Right now, it's more of a coin flip. But again, that's something from a risk standpoint that does exist. However, it is more quantifiable in that once we have an idea of the candidates themselves, you can start to at least kind of game plan, as Scott mentioned earlier, for what the possible outcomes look like. So that's absolutely something that we're still monitoring internally, but has been overshadowed, I should say, over the last couple months now. Another risk that maybe entered the market more recently was this oil shock that we experienced. And Scott, I think it's fair to say we've experienced maybe similar magnitudes in the past, maybe just a slightly different time period in terms of how quickly it happened. But maybe talk us through the risks with the oil shock that we experienced, and maybe unpack it a little bit, because I think there's more to it than just the price of oil and the impact thereof.
Yeah, Austin, and you said it right. We have experienced shocks like this in the oil market before, but the last two times that oil dropped 70%, in 08 and in 2015, 2016, these were largely demand destruction types of events. There were not necessarily supply issues. This instance is kind of a dual shock to the system, in that it's both a supply event and a demand event. We do have OPEC Plus kind of falling apart. It looks like they may be starting to get back together again, but nevertheless, a great deal of damage has already been done. But we also have the demand destruction coming out of the global economic shutdown from the COVID virus. But the fact that oil is down 70% is modestly interesting for the U.S. in that it's not an obvious conclusion for the impact of the U.S. anymore, because the U.S. is a net exporter of oil now. So you have it's good for consumers in that we have lower gasoline prices and things like that, but it's bad for capex. So the direct effect on the United States isn't as clear, but the indirect effect on financial markets is very clear. The indirect effect is that if you have sovereign nations that derive the majority of their income, or the majority of the revenue from the sale of oil, and they need to use those funds in order to do their social programs and run their economies, those countries, if they can't get enough money from selling oil, then they have to go and sell something else. And oftentimes that is treasuries or investment grade bonds or U.S. equities, global equities, but they're certainly concentrated in the United States. And so the secondary effects of a move like this, especially with the speed that it hit, is actually sovereign wealth funds having to sell stock and having to sell bonds. So whenever we get moves like this in the oil market, yes, it's sort of important from the oil side, but really where it comes into play in the financial markets is it creates a new swath of forced sellers into the market. And as we're going to see in a couple of slides, those forced sellers came at the same time as some other forced sellers in an environment with very, very poor liquidity conditions.
Yeah, Scott, you talk about liquidity conditions. I think that kind of moves us nicely into this risk that we'll talk about in regards to structural issues. And maybe the two that we'll touch on more broadly would be volatility, which we've got a couple charts here, and then the next slide we're talking about liquidity specifically. I think we can see here just how much volatility spiked over the last month and a half now. Maybe talk to us about these two specific measures and really what that means from a market perspective.
Yeah, so this is I do want to kind of make the point that the volatility that we experienced largely in March in equity markets is literally without precedent. We experienced higher volatility than we did during even the Great Depression. So the volatility shock that we got was massive, and really, again, difficult to game plan for because this is without historical precedent. But outside of the fact that it's interesting to kind of volatility geeks like me, again, the second order effects, the kind of the knock-on effects of why does this matter? Okay, great. So volatility size. So so what? Well, it matters because there is a large contingent in the marketplace that you could quantify or kind of classify as volatility sensitive investors, or VAR sensitive investors. VAR stands for value at risk, just measurement of risk. Volatility sensitive investors are people like many hedge funds, commodity trading advisors, all bank trading desks, and retail people really kind of behave like volatility sensitive investors, even if they're not formally. Systematic strategies are also a form of volatility sensitive investors, things like risk parity and volatility targeting strategies that are popular with insurance programs. So these types of investors, which are large, if you get a volatility shock, their system is going to essentially say, you need to reduce size, you need to bring risks down. And for the most part, that's just going to mean selling stocks and selling bonds. So again, the volatility shock in and of itself isn't the problem. It's what does the volatility shock mean for investors that are sensitive to volatility shocks? And what it means is it forces them to de-risk. It forces them to get out. and the speed with which this move happened and the violence with which it happened meant that they needed to get out in an increasingly fast speed. And the next slide is going to show you that, not only do we have sovereign wealth funds needing to sell during this period of time, but we had a lot of these volatility sensitive investors needing to sell. And here's the liquidity environment into which their offers were proffered. On the left side is a picture of basically stock market liquidity, and on the right side is treasury market liquidity. I could have shown you a zillion different slides illustrating these same points, but just trust me, anything I was going to show you are going to tell you about the same story, that it was garbage. Liquidity in this environment, it was really, really poor. And so in a typical day in the stock market, if you wanted to sell, you could sell $50 million worth of S&P futures and not move the market, not move the price. In most of March, if you needed to sell $3 million worth of stock, you were going to move the market. Like, think about that, it's $3 million. That's a crazy low number. So it's just, if you needed to sell stock, you're going to move the market a material amount. The same thing happened on the treasury side. Something that we really haven't seen all that much of. Treasury liquidity actually got far, far worse. We got to a place in the middle of the month when the treasury market essentially couldn't price securities. And we'll talk about that in a little bit, but that's why the Fed came in with the bazooka that they did. It's because the treasury market essentially broke. But the reason why it broke is because there was all one-sided price action coming from these systematic strategies and from these vol-sensitive investors, broadly speaking, that hit at a time with a very, very poor liquidity. That liquidity, by the way, as a kind of a side note, these liquidity conditions are likely the result of the large move towards passive over the last decade, where you don't have market makers and market making functions, a lot of banks and hedge funds anymore, and due to some of the regulations that have been placed on market making types of folks. So it's not really a surprise that we're in this liquidity situation right now, but it is the reality for the at least the near term future.
Yeah, so Scott, I think kind of hearing you talk about the volatility component, the liquidity component, I think that brings us nicely into this last piece on the structural side, and just the scale to which we saw allocation changes in the month of March. I know we've used the Bank of America Global Fund Manager Survey in the past to show month-over-month changes, but I think this chart specifically does a pretty good job of highlighting just how extreme de-risking or selling of equities that we saw in the month of March. Is that a fair assessment?
Yeah, I mean, look, I've never seen numbers like this in my career. You're talking about 35, 40 percentage points of getting out of basically selling equities from global fund managers. It's an astounding amount of de-risking happening in the span of a month. So everything I've been talking about in terms of this feedback mechanism, this feedback loop of volatility shocks leading to poor selling in a very liquid environment, led fund managers to be liquidating in really, really challenging periods.
Yeah, so Scott, I think that maybe allows us to transition from what we saw from a risk standpoint. Again, think of it as yes, slightly elevated or abnormal conditions when it comes to volatility and liquidity, but maybe then outside to kind of some uncertainty. So this chart specifically looks at and shows you the extreme nature to which systematic strategies sold equities. We just talked a little bit about that. We talked a little bit about risk parity being forced to sell. But I think, Scott, you've got maybe a behind the scenes type of point when it comes to these strategies on a go forward that could be a lot more impactful, kind of that, like you said, those second derivative types of conversations.
Yeah, I mean, so this is a picture again of just of a strategy called risk parity, which is and sort of their positioning. But risk parity, for those that are unfamiliar with it, is a strategy where essentially it's a stock and bond portfolio in the simplest form, but it's stocks and a levered bond, and so you can think of it as just another form of diversification. But the point that I wanted to make out of this is that what's the path forward for a strategy like risk parity specifically, and what's the strategy what's the path forward for, even more fundamentally, using fixed income as a portion of a balanced portfolio or a kind of a more of a moderate portfolio. If we're in a place now where the Federal Reserve is not expected to hike rates for the next 4 to 5 years at least, which I think is probably about right, that means we're going to have Treasury rates in the neighborhood of 1% or below for the foreseeable future. how do you construct a balanced portfolio in that world? I think that's a problem that the investment community writ large is going to be grappling with and trying to figure out how to solve, because bonds are not going to have the same sort of diversification and risk mitigation techniques or properties that they've had for the last 40 years. And further, if you extend that out one place further, what about retirement income portfolios? How does the financial engineering work for a retirement income portfolio with yields at 1%? It's a very different financial engineering problem than it has been really since anybody listening to this call has been in the business. And so that means that there are going to be new solutions being proffered. That means there's going to be new engineering that needs to take place, new research needs to take place. We think at Horizon that the answer for that is going to be obviously an increased equity allocation sort of across the board, but probably that increased equity allocation is going to need to be with some sort of risk mitigation component attached to it to deal with the signature return risk and catastrophic risk that's associated with such a thing. But the point is, if we're going to have very low rates for a very long time, what does portfolio construction look like in the next 20 years? And what do retirement income portfolios look like for the next 20 years? We think they look very, very different than they have the last 20.
Yeah, Scott, that's a great point. I would tell folks on the phone, as Scott mentioned, that's something that we've absolutely been talking about for a while now internally. So don't be surprised if you do see pieces that we begin to put out in regards to just continuing to share ideas around kind of that financial planning concept or challenge in a zero rate environment, something that we're definitely thinking about on our end. Now, Scott, you mentioned earlier kind of the idea of the treasury market breaking down, and I think this is the slide in here that maybe gives us the best screenshot, if you will, of that. But maybe talk us through what happened, maybe what we're looking at here, and then what has happened since then.
Yeah, and again, this kind of falls into the category of I could have shown you a zillion different charts, but they're all going to tell you basically the same story. And that story is the treasury market really did kind of break for a little bit of time in the middle of March. And so if you're wondering why the Federal Reserve came in with the power and the size that they did and the speed with which they did, it was because they realized that people couldn't price off their own treasuries. The treasury market had functionally ceased to properly function. And if you can't price the risk-free security, how the heck are you supposed to price anything else in the world? Like all asset pricing is based off of I know what the price of the risk-free security is at least, and then I can do something else to that to figure out what the price of an equity security is or a bond or anything else. But the treasury market, it literally stopped really functioning for a few days there. And so the Fed came in and they came in with their bazooka, and here's a picture of it. And so they took the balance sheet from 4 trillion to 6 trillion in pretty short order. And guys, this is going to 10 trillion really fast. And the programs announced this morning are going to be a part of that. But the reason why they came in and they actually acted with what we think very responsible haste and precision in order to try to solve a problem in the treasury market that was really set to make things much uglier. Because if you lose the ability to do repo, or you lose the ability to price treasury bonds, then you basically have to shut down. And so the Fed saw that, they realized the severity of the problem, and they acted with the appropriate amount of haste and of size. And so what they're doing, like as of this morning, when with including some form of high yield stuff in that, and some leverage loans and some muni stuff, that's we're going to be figuring that out over the coming days. What sort of moral hazards that introduces. But what they're functionally trying to do is just get the bond market to be able to function again properly. And so that is, and it is going to work. It has not worked. We're not quite out of the woods from the liquidity and from the plumbing of the market standpoint, but it is in the process of working. And we think that they certainly have the size and the wherewithal to be able to force it to work at least for some period of time.
No, it absolutely makes sense, Scott. And I think kind of taking that and what we saw in the fixed income markets, and obviously how that spread just market wide from a volatility standpoint, then that contributed to this idea of sentiment and kind of some of the uncertainty surrounding that. I think this page gives us maybe two different views. One at the consumer level here on the left-hand side, the other more of the investor sentiment on the right-hand side. maybe talk us through these two charts specifically, but then more broadly, what we're seeing sentiment-wise, and obviously the pullback and the stark pullback that we saw during the first quarter.
Yeah, so this chart on the left is an index that one of our research partners, a firm called Cornerstone Macro, has been keeping up for almost 20 years now, and it's a daily measure of consumer confidence. It's a really cool data set that they've got, and you can see just the absolute falling off a cliff that consumer confidence is. This is kind of a picture of Main Street. It looks like it may be stabilizing here. We're certainly going to be watching this on a daily basis to see and verify that. But it's just kind of a picture of what you guys already know, is that Main Street is certainly taking a hit with this virus. That said, the right side is the TD Ameritrade Investor Movement Index. And so this is an index that TD puts together that is essentially a sentiment barometer for retail investors. And the orange line there is that index. And if you listen to me talk over the months leading up to this pandemic outbreak and the economic shutdown, you'd heard me say that this nascent recovery in retail sentiment is actually a really good thing, because usually when retail guys get going, they are buyers for a prolonged period of time. The retail guys kind of given up the ghost here, so they've really taken a shot to sentiment. That's not a terribly helpful thing in the short to medium term. It's something that we will be watching, but it's it is a change to our view from the last quarter. When we thought that retail was going to be a pretty good tailwind of this market, it doesn't look like that's going to materialize, at least in the next couple months.
No, for sure. And I think this sentiment conversation maybe feeds into just the larger conversation around business activity, and specifically kind of small business activity within the U.S. I think this was a pretty interesting chart that we got from Goldman Sachs in regards to a survey that they put out looking at small businesses. And maybe the way to read this is, how much do these small businesses have in the way of reserves set aside to facilitate an economic shutdown or a shutdown of their business. And what this chart would tell you is that unfortunately over 50% of small businesses have less than 3 months worth of those reserves. And I think, Scott, and tell me if I'm wrong, or tell me kind of your opinion as well, but I think that's where these stimulus packages can be the most impactful in regards to keeping small businesses around the country up and running, knowing that there's literally trillions of dollars of wealth that small business owners have within these businesses.
Yeah, I mean this is what the Fed is trying to is trying to take care of. One of the programs this morning is essentially a securitization plan for the payment or the Paycheck Protection Program. So really basically take all the risks out of away from the banks. Basically just let the banks be facilitators of the Fed's money into small business. It's kind of a fascinating development. It's one that it's not terribly surprising, but again, the speed that they're acting on this thing is telling you that they're seeing stuff that is worrisome to them. And they because this analogy has been made before, but it's very, very true, and it bears repeating that the economy is not a patient. The economy is not a person. You can't just put the defibrillator on it and have it restart and have it be pretty much as good as new again. If these small businesses are shut down, people go to look other places for work. You have to go rehire people. You got to retrain them. You have to get your supply chains back in order. You have to have customers that come back in the door. It is a potentially long and drawn out process if they have to shut down. If they can keep their business essentially in a continuous state, even if they're not getting revenue, then the reopening process is far quicker. And so these are the types of things that Washington and the Fed are actually trying to get done right now. And it's pretty interesting to watch them go at it. But we're still looking at the details of this program. But it looks like a lot of the actions today are aimed at really trying to facilitate and essentially let the banks say, hey, listen, you don't even really have to underwrite this stuff. We're going to take the risk off of you. Just get the money out the door.
Yeah, and Scott, I know this is something that we've touched on in previous calls, but I think it's been, and you've hit on just how fast these stimulus plans have come to bear. I think the challenge that the Fed realized, and again, tell me if I'm off, but I think the challenge the Fed realized is they have a great way to support maybe corporate America, like large corporations or the financial system as a whole, big banks. They didn't really have a great method to get money into the hands of small businesses, and I think the way they've done it, at least on the face of it, seems like it may work. I mean, you tell me in terms of just kind of what we're seeing.
Well, and that's what we're all going to be watching for. I mean, and that, probably the most important data set over the next week or so is how much of this PPP program is actually funded, like how much money is actually getting out the door. And the Fed's action today is meant to is meant to speed that process along, just by telling the banks, guys, don't worry about underwriting these loans, just get the money out. We're going to be buying them. We're going to be buying the loans from you, kind of whole hog. So don't worry about it. Just sign the paper and write the check.
No, for sure. So we touched earlier on kind of this, specifically the jobless claim numbers, and really what would happen if you entered a nonsensical data point like that into a model, for example. And I think this is a perfect picture of maybe what you would expect to see as you start to get data that maybe doesn't jive with the models themselves. So what you're looking at here is estimates, GDP estimates for the next 4 quarters, including Q1, from a number of different, large banks and companies that put out their own GDP forecasts. And what I would tell you is if you look at the table in the top left-hand corner, you see a spread for first quarter GDP of over 11%. Now, keep in mind, on a normal quarter, that spread is maybe a couple tenths of a percent, right? We're arguing over, is GDP going to be 2.1% or 2.3%? In the first quarter alone, we're arguing about whether it's going to be a +1 or a -10. And then fast forward, as we get further out into 2020, you have spreads 50, 60, 70%, telling you that the models that have been built based on historical data and historical standards just don't hold up. And Scott, I think this gets at what you were talking about earlier, that just some of the rain or the unprecedented data points that we're getting, that's giving you obviously just nonsensical numbers in many cases.
Yeah, this is a picture of what happens when you let idiot economists just take blind numbers and put them in some sort of fancy math model. You get numbers like this. Listen, you have to understand how the models are built, what the math does, why it's there, and what it's meant to do, and what the assumptions are underlying how the model's meant to function. Because essentially what economic forecasting models do is they say, let's see what's going on today. Let's find similar types of periods or similar types of things in the past, and use those to create some sort of forecast about what's coming next. Well, what happens when what's happening today there is no historical precedent for it? Because today the numbers that we're getting economically, there is no historical precedent for. So if you try to plug numbers that you're getting today, like these claims numbers, into a math model that relies on historical data in order to generate a forecast, you're going to get dumb looking numbers like this. And anybody putting out a number that comes out of something like that should just be summarily fired. But that being said, what's the point of doing a forecast on something when you don't really have any way to judge the veracity of it, or to even have any expectation for how like where the confidence bands are around it. And so we're really not focused today at Horizon, at least, on what does the GDP forecast look like, because there's it just doesn't even matter. Like my 5-year-old could come up with a more sensible forecast than some of these models, because it's just at least be an honest guess and should be honest about it. But the thing that we're focused on now is really this idea of how do you transition what is a very uncertain set of things right now, a very uncertain set of circumstances. How do you transition that uncertainty into risk? And the thing that we're going to need is time. To be able to quantify the time of the shutdown. We'll talk about that and kind of like how we're thinking about doing that in a little bit. But just know that this is kind of a public service announcement, that any economic forecast you see coming out you really should just basically ignore, because if they're using the history to try to generate a forecast based on the numbers today, they're gonna like the numbers they're not even as good as the paper they're written on.
No, and Scott, I think you bring up a good point around this idea of a timeline. And the last kind of uncertainty, obviously, that we're going to unpack is the virus itself. And I think this idea of a timeline around that virus, and obviously all of the parts and conversations that come with that is like you said, probably what we're working on and focusing on as much as anything internally in regards to the forward outlook. I think this chart, obviously, there's a lot of things going on in this graphic. I think it's also fair to say that there's a lot of moving pieces that we at least want to try and keep a view of. So obviously you see kind of the new cases graph. You see a number of data or time periods or time points in time that are worth monitoring. And Scott, you tell us, is there any one data point that's maybe more important than the others, or just maybe walk us through this timeline conversation in a little bit more detail?
Yeah, I mean, this actually, this is a pretty helpful little graphic just to give you an idea about all the different things that are being done and all the different sort of data points that we need to monitor in somewhat real time in order to get a gauge as to the sense of the progress of the virus in different geographies and different locales. And because what I think the best path forward for trying to transform uncertainty into risk is to get a gauge, get a really good handle on these data, get a really good handle on the kind of the path of the virus, and then associate that path, like that point on the graph, that point on the curve, with some level of economic activity on a go-forward basis. And because we're starting to get, like this thing obviously started in China and it moved into Asia, but we're starting to get some data about economic activity in these other parts of the world in more real time, like big data kind of stuff. And if we can build some sort of model or build some sort of forecast or methodology by which we can say, listen, you are here on this virus curve, and if you are here on this virus curve, then that implies some level of economic activity, 1, 2, 4 weeks hence, based on what the other geographies that have had this virus to have the same kind of thing happen. And so those are the kind of forecasts that I think could actually stand, could actually hold some value, and could actually lead you to some reasonable conclusions. That's the kind of work that we're actually doing right now.
Yes, Scott, I think you bring up a good point in regards to the effects of the timeline itself on the economy, but then also on kind of the consumer that lives in that economy. I think this is a really interesting graphic. McKinsey and Company did a survey in regards to looking at confidence around the world, and I think what you see is that kind of waxes and wanes with where an individual country sits within that timeline or in regards to the virus itself. So this was taken maybe the third week of March, and what you see is, so for a country like the U.S., which at the time we were at the very kind of beginning of the pandemic kind of flowing through the U.S., confidence was still a little bit higher, right? Whereas in Europe, Spain and Italy specifically, they were kind of in the throes of it at that point. You see confidence much lower. You see a much more pessimistic consumer. And then you see the China data set there on the far right, where in the third week of March, they were kind of on the backside. They were coming out of the pandemic and how it had affected their economy. And I think what you see is the optimism shift within their economy. I think that's really telling. The other component, and Scott, I know you'll talk a little bit more to this, but is kind of economic activity. And I think this is a good graphic. Maybe, Scott, tell us a little bit about this graphic and then just more generally what we're watching from an economic activity standpoint.
Yeah, and this is the kind of economic activity data I was talking about earlier when we were talking about associating a point on the virus curve with a level of economic activity, either concurrently or on a go-forward basis. So this is a data set that is out of a firm called WeBank in China. It's an artificial intelligence firm. And there's similar types of things all over the world, in Singapore and Taiwan, other geographies that have had virus exposure. And the upshot is, these data sets or these ways of analysis are meant to detect basically levels of economic activity. So think about like tracking pollution, tracking traffic, tracking restaurant reservations, just like anything you think of that will sort of be a sideways look at GDP or a sideways look at what does current economic activity look like relative to some baseline. Those are the types of data sets that we think are actually going to be pretty interesting here as we try to analyze this kind of once in a lifetime phenomenon that we're dealing with. And so these data here are saying that China, right now is operating at somewhere between 80 and 90% of economic activity. So they're not all the way back, but they're largely back. And we can talk about taking data out of China with a grain of salt, and we would agree with that. But there are other data out there, like from South Korea and other places that are a little bit more reliable, that are kind of telling you a similar story, that this far past when they're at a fairly low point on their virus curve, 4 to 8 to 12 weeks later, they're looking like they're clocking in at approaching normal types of levels of economic activity. That concept, that saying, listen, once you're here on the virus curve, then 12 weeks out, 16 weeks out, whatever the time is, that's the period of, that's the time over which economic activity essentially returns towards normal. That's the most important thing we can get our hands on in order to transform uncertainty into measurable risk. Once we can do that, now we got a shot at forming expectations for financial markets and other things that are much more coherent than just sort of throwing darts at the board. And so that's, this type of analysis, I just want to kind of fill you guys in as to what our thinking at the Horizon was. This type of analysis is the type that we think is going to be the most, the most time sensitive and sort of timely in order to try to figure out, where are we on this path? What is, the classic question, what's priced in? It's an impossible one to answer right now because nobody knows what some of the effects are. But at least if we have a gauge as to what the time frame looks like for the shutdown, then that's at least a starting place for us to be able to figure out what is actually priced in and what's the likely path forward.
Yes, Scott, it definitely makes sense, and I think kind of hinting at that idea of turning uncertainty into risk, just at the high level is obviously one of the big things that we're watching for, and maybe one of the key takeaways in addition to what we've listed out here. We have had a couple questions come in, Scott, while we're talking. I think the first from Monroe Campbell is, many companies, unfortunately are unable or can't really hold as much cash on the small business side because of tax consequences. Do we foresee the tax law changing possibly to allow businesses to carry a little bit more cash in the event of another event like this? Is that something, I don't know that I've heard anything about that, Scott. Have you heard anything along those lines or any thoughts on that?
It's a really interesting question because it gets at a phenomenon that we saw and that's fairly well documented coming out of the 08 crisis, and that is, like, if you want look, if you want the untalked about reason why interest rates are so low, and why they grinded towards zero and likely there for a very long time, it's because coming out of the 08 crisis, people realized that they needed a bigger piggy bank, they needed more savings, and so they're spending at the individual level, at the household level. The spending patterns changed dramatically and really were a structural break from how people have behaved in the last 100 years in the United States. And so you had very high savings rates, stubbornly high savings rates, frankly. And that's, that has gotten people into a generally better place, but it also has kind of knock-on consequences. I would guess, and the reason why that's a fascinating question is I would guess you're going to see the same type of corporate behavior out of owners of small business after this is over. It's not like people are going to forget this happened and just go back to doing exactly what they did, exactly the way they did it. And so it would not surprise me at all to see the Trump administration make a move to make that a less onerous thing to do, because it would help shield small businesses from the effects of something like this in the future. And we've all seen how devastating this can be in such a short amount of time to small businesses without the wherewithal to really properly save and plan for something like this. So I mean, and not to any question, I think it's certainly possible, and probably more possible if Trump wins re-election than if Biden's in the White House.
Yeah, no, I think that's a great point. Scott, so another question that came in, this one from Colin Larson. With all this Fed rescue action and we've seen and the magnitude therein, do we have to worry about credit worthiness kind of creeping into the markets? Is that something, obviously that we're worried about just generally at Horizon? Is that something you think the market worries about more broadly?
It is something that we are going to definitely have to deal with once this acute phase passes, Colin. And yeah, and that's a great question too, because look, today's introduction of fallen angels and sort of obliquely high yield ETFs and some portion of leverage loans and munis into the Fed's purview is a pretty surprising move. And so what does that do to the moral hazard of issuing debt that is a little bit more questionable? I wish I had more coherent thoughts on it. We're still actually kind of forming them. I'm kind of forming them as I talk right now. But it's something that is definitely going to have ramifications as to how you price debt. It's going to have ramifications for how you trade things and how you do asset allocation. Because if these things are within the Fed's purview, then just like equities and treasuries and MBS, it's going to change the calculus for what the right asset allocation looks like on a go-forward basis. But we still need to dig into the details of the actual ruling, and frankly, we need to see how they actually execute it. Because just because they have the power to do it doesn't mean that they necessarily will. And so watching how they actually execute these programs is going to be really key, and to try to figure out where the hazards lie after the dust settles a little bit.
Yeah, Scott, one last question that came across, and then we can absolutely wrap up. I know we're pushing a little bit long, but I do feel like all this hopefully has been helpful. Last question, we talked about the allocation changes just broadly. Obviously, folks on this call have seen some pretty big allocation changes, specifically within some of the risk assist strategies. Maybe, Scott, broadly speak to risk assist just in terms of how we feel like it acted during the first quarter in terms of relative to expectations on our side, and then obviously what we're looking at from a reinvestment standpoint in terms of criteria for us to start to reinvest those risk assist strategies.
Yeah, I mean, so for folks on the call, or for folks that had exposure to the risk assist strategy, I hope you're as pleased with it as I am and as we are, because this strategy performed precisely how we expected it to. So in terms of delivering expectational certainty for the strategy, which is one of our core principles at Horizon on the investment management side, it performed precisely how we expected it to, and especially in an environment with well, as I said before, with literally unprecedented levels of volatility, like even more than the Great Depression, it still was able to really kind of nail what it was meant to do. And so that's so we're very thankful for that, and we're very happy about that. Luckily we're not surprised by it, but it did perform as expected. On the that of course is only half the problem, though. The other half of the problem for risk mitigation programs is the how and the why do I get back into the market. And for that, as many of you I'm sure are aware, there are three essential factors for determining how risk assist reinvests money once money has been taken out. And those factors are time, performance, and volatility. And we use our volatility forecasting to help avoid to try to avoid whipsaws. And on the reinvestment side, those volatility forecasts end up playing a very large role in terms of figuring out the timing, not the timing, but the speed and magnitude with which the reinvestment will happen. I'll just tell you that the volatility forecasts that we've been running are coming down markedly over these last week or two, and that is speeding the reinvestment process from what it otherwise had been. So we have done previously, we've started the reinvestment process here, and I would expect that as volatility continues to come down, if it does, and markets at least kind of remain stable or kind of grind higher, that process would continue. Obviously, if markets turn back south again, then the process, the risk assist algo will re-engage to the downside. But if we do continue to recover, then risk assist will do exactly what it's designed to do.
Awesome. Well, Scott, we really appreciate your time this afternoon. and really appreciate everybody joining us on the call. Again, I know we went probably a little longer than normal, but I do feel like there was a lot of information that we were able to cover. Look forward to catching up with folks as part of the quarterly process. I would say don't hesitate to reach out if there are questions in the meantime, and hope everybody is staying safe and staying healthy, and hope to talk to everybody soon. Thanks so much.
Thank you, guys.